Want to keep more of your investment gains this year? These are the smartest tax saving strategies every investor should know in 2025. Hey everyone, welcome back to the channel. It's your money, and you should keep as much of it as possible. That's where tax smart investing comes in. Optimizing your taxes can be just as powerful, if not more so, than picking the hottest stocks or funds. Today, we're breaking down actionable strategies to help you legally reduce your tax burden and grow your wealth in 2025. Strategy number one, max out your tax advantaged accounts. We're talking Roth IRAs, 401ks, and HSAs. These accounts offer incredible tax benefits. With a Roth IRA, for example, your contributions are made after tax, but your earnings grow tax-free, and withdrawals in retirement are also tax-free. A 401k offers tax-deferred growth, meaning you don't pay taxes until you withdraw the money in retirement. And an HSA, a health savings account, offers a triple tax advantage: tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. Sarah explained enthusiastically and clearly. Here's an example. Let's say you invest $6,500 into a Roth IRA each year for 30 years, and it grows at an average of 7% annually. Because of the tax-free growth and withdrawals, you could end up with hundreds of thousands of dollars more than if you invested in a taxable account. Next up, use tax-efficient index funds and ETFs. Index funds and ETFs generally have lower turnover rates than actively managed funds. This means fewer taxable events like capital gains distributions. Look for funds that track broad market indexes like the S&P 500 or the total stock market, Sarah said informatively and concisely. Strategy number three, take advantage of capital gains tax brackets. Capital gains taxes apply when you sell an investment for a profit. The tax rate depends on how long you held the investment. If you held it for less than a year, it's taxed at your ordinary income tax rate. If you held it for more than a year, it's taxed at the long-term capital gains rate, which is generally lower. Plan your sales strategically to stay within lower tax brackets, Sarah explained clearly. For example, if you're in the 12% income tax bracket, your long-term capital gains rate might be 0%. That's free money. Fourth, tax loss harvesting. What is it, and when should you use it? Tax loss harvesting involves selling investments that have lost value to offset capital gains. You can use these losses to reduce your tax liability. If your losses exceed your gains, you can even deduct up to $3,000 of those losses against your ordinary income, Sarah said informatively and practically. Imagine you have $5,000 in capital gains and $3,000 in losses. By tax loss harvesting, you can offset the gains and only pay taxes on $2,000. That's a significant saving. Number five, asset location. Where to hold what? This strategy involves strategically placing different types of investments in different accounts to minimize taxes. Generally, you want to hold assets that generate the most taxable income, like bonds and REITs, in tax-deferred accounts like 401ks or traditional IRAs. Assets with high growth potential, like stocks, are better suited for Roth accounts, Sarah explained informatively and strategically. Sixth up, Roth conversions, especially in low-income years. A Roth conversion involves transferring money from a traditional IRA or 401k to a Roth IRA. You'll pay taxes on the converted amount in the year of the conversion, but future growth and withdrawals will be tax-free. Doing this in a low-income year can minimize the tax hit, Sarah said informatively and concisely. And finally, reinvest dividends strategically. When you reinvest dividends in a taxable account, you're essentially buying more shares. This increases your cost basis, which can reduce your capital gains when you eventually sell the shares. Be sure to keep track of your dividend reinvestments for tax purposes, Sarah advised informatively and practically. So, to recap, maximize tax-advantaged accounts, use tax-efficient funds, leverage capital gains brackets, practice tax loss harvesting, optimize asset location, consider Roth conversions, and reinvest dividends strategically. Remember, everyone's situation is unique. It's always a good idea to review your portfolio and talk to a qualified tax advisor to determine the best strategies for you, Sarah said, friendly and reassuring. Subscribe for more ways to build wealth smarter, not harder, and comment which tax strategy you're already using. Before we wrap up, let's answer a couple of viewer questions, Sarah said. welcoming and interactive. Great idea, Sarah. We've got one here from Jake in Texas. He asks, are there any tax saving strategies specific to people in high income brackets? Excellent question, Jake. For those in higher income brackets, pairing tax loss harvesting with donating appreciated assets to charity can provide significant tax benefits. It's also wise to consult with a tax professional for personalized planning. Sarah answered informatively and considerately. We've got another from Lisa in New York, wondering about income splitting strategies for families. Lisa, income splitting through family trusts or gifting strategies can be effective. Just watch out for gift tax implications. Again, a tax advisor can tailor these to your situation, Sarah said helpfully and clearly. Thank you to everyone who sent in questions today. We love hearing from you. Remember to subscribe and keep the questions coming. We're here to help you navigate your financial journey. Sarah encouraged warmly. Until next time, stay smart with your investments.